Welcome back to the MHP Show podcast. I'm your host, Derek Vickers. We're talking about mobile home parks, anything that has to do with operations, recent deals, the current market. And I got to tell you, I'm glad to be back. I'm glad to be back on a live here. I hadn't done a live in a few weeks, and it's good to be back. You know, I enjoy getting on here and doing these things and talking shop. And believe it or not, if you've ever done a podcast and, you know, had to do it by yourself and you don't have a guest, I think the show can tend to be better sometimes. It's good to mix it up, I think. But it's actually harder to do than when you have a guest, because you have questions to ask them, and it's a bit easier. But you know, when I do these episodes by myself, there's a bit more thought and preparation that goes into them. And so I'm excited to be here with you guys today. And who knows how long we'll go, but we're going to get into it. And before we do, we have a new entry level program to investing in mobile home parks. We will throw that link in here at some point, but you can check that out if you've seen it come through on Facebook. It's a sick program. It's like bottom dollar cost, and anything that you need to know to have the confidence to get started, you'll learn in that program. And again, we'll throw that link up here. But today we are going to talk about the key metrics now in 2024 that you need to evaluate before purchasing a mobile home park. Now, I know this sometimes can be different for people and different for whatever your buying criteria is, because people have different buying criteria. And I think it confuses a lot of people, because I talk to people that are looking to get into this business. They're looking to buy their first deal. And when you first start looking at deals, I know there's a bit of confusion on like, oh my God, how do I tell if this deal is good or not? You know, so-and-so says they love to do infill. Derek says he hates doing infill. You know, Johnny says he likes doing this. Derek loves park-owned homes. Susie hates park-owned homes. Like, there's a mixed bag of information around here. But I honestly think, got my buddy calling me here. But I honestly think that, yes, you have to get in and sort of figure out what your buying criteria is. And I think the proper goal to get to is a tenant-owned home mobile home park, which I like. But there are certain factors that we want to look at that I pay a lot of attention to. And you've probably heard me talk about some of this stuff before. So we're going to get into that. I got my coffee here with me today. I hadn't had it today, so it's 1 o'clock, and I'm drinking coffee for better or for worse. So the first thing you got to look for, like, the location is huge, okay? And you've heard me talk about this, right? You've heard me talk about this. Like, the location factors are so vitally important. It is almost like the location can carry the deal. You know, it's going to determine what your exit strategy can be. It's going to determine a lot of things. It's going to determine like so much. And that's why I'm so big on the location. And the old adage that we've all heard, real estate is location, location, location. We've all heard that 60 billion times. It's freaking true. It's true. It is 100% true. And this is so important in mobile home parks. And so when you're looking for this, so we just recently closed a few parks last month. 2 of them were in Lakeland, Florida. So I'm going to explain to you why I look at this market and why I like it, right? And I'm going to give you some other examples here. But I love this market because if you look at where this particular place is on a map, if anybody knows Florida, and maybe I can pull up a map here and just show you. Let's see, Lakeland, Florida. Because this market is actually right in between Tampa and Orlando. It's 45 minutes from Tampa, about an hour from Orlando. It's right on the I-4 corridor here. So let me see if I can pull up this map just to show you. And you're like, oh my God, well, why are you showing me this? And why are you blah, blah, blah? So let me just share the screen here. If we can even do that on here. Let's just try it and see. Maybe you can see that now. Yes, you can. So as we see right there where Lakeland is, why do I like that? Because look how close it is to Tampa. Look how close it is to Orlando. The Tampa MSA has millions of people in it. The Lakeland MSA here has almost, the Lakeland Winter Haven MSA, Winter Haven's like right over here, has almost 1 million people in it. I think it's about 800,000 and growing. Now, I love this because it is expensive to live in Tampa. It is expensive to live in Orlando. And if you're down here, this is essentially Orlando, but this is where you're getting around Disney. It is expensive to live there. So where are people going to go? They're going to go to these places. Someone in Disney could live in Lakeland, essentially, and drive and work there. Someone could live in Lakeland and drive to Tampa and work. So I love where this market is situated here. And so when you're looking at a market, like where is it situated between the cities? Like, is it within an hour drive to a massive MSA? I love that. And I think some people, maybe they look at, if it's 50,000 or more, but I want to be close to the big cities. Dallas, Orlando, Tampa, Tucson, Houston. I like those particular areas. We don't own in those areas yet, but we have actually started to look for deals in those areas. Now, that's not to say, and maybe I'm contradicting myself here, but people do find deals in other areas, right? People do find deals in rural areas. Like, I don't particularly like to buy stuff in rural areas just because of the fact that I know stuff is going to be slower, and you've heard me talk about that before. But we purchase these deals in these areas because where that market is situated is so important, because that market is going to get the pressure from Orlando and Tampa, right? There's going to be population migration there because that area is growing because it's situated right in the middle of these two massive markets where people are moving. It's a red state. And it's warm. And some of the migration has slowed down a little bit in Florida, but not really. And I think it's going to continue to go that way. It's totally going to continue to go that way. And because of where this is located, the demand for affordable housing in this area is massive. And I don't know if I'm still on my screen here, but let me pull up something else. Because if you look at some of the cities that are around this, let's just take Tampa, for example. I'm going to look this up on best places. And I'm going to go to cost of living here. And I'll pull this up again. I'm going to go to cost of living here. I hope
catch every
of course the guy's going
to see which team takes it all the way. With Spectrum and ESPN,
I don't know if you guys can hear that or not, but
get Spectrum.
Kind of annoying.
Let's talk about.
Anyway, so look, a 2-bedroom apartment in Tampa, $1,700
because it's all about affordability, and you have to be able to afford
this
a great place to live. Up near the top of the page,
we're just going to boot out of it because I'm sick of.
It's going to be around 100.
Listening to this guy.
100 is the national average. In our cost of living index, and this is an index because it compares.
There we go. We can shut the guy up here. Okay, so look at this. So a 2-bedroom apartment in Tampa, $1,700, almost $2,300 for a 3-bedroom apartment, right? So times 2,300 times 12, that's $27,000 a year it would cost to live there. Do you think that there's an affordable housing? Do you think there's an affordable housing demand in this area? 1,000%. 1,000% it is, because that's expensive. That's expensive. And some of the nicer places are going to be nicer than that. And I mean, you can probably get a crappier place in Tampa for sure, but you might have to duck at night and you might have to wear your Kevlar vest. For you Second Amendment people, you're going to have to exercise that if you're going to be living in a cheap place there. So my whole point in talking about this and bringing this up is because that allows for more demand in affordable housing, because that's going to put pressure, because a lot of people can't afford that. And mobile home parks are the cheapest place in town. And when you're closer to a big city, there aren't as many of them. Yes, there's a higher barrier to entry and buy-in in some of these MSAs for sure. But what does that mean for you on your exit? If someone wants to throw that in the comments, you can throw that in the comments. But what does that mean for your exit? That means that there's going to be more people that want to buy your asset. Now, I know this asset class has been getting more popular. So even if you are in the middle of nowhere, you may still get someone that wants to come and purchase this asset. And Mr. Paul said, mo money. That's right, dude. Mo money. It's exactly what that means. All right. So look, that's why I'm telling you, you have to do this market thing and really pick what market you're going to be in. And I'm telling you, I like to be around the MSAs where we've got close to 1 million people in them, or it's going to pull and be within an hour of one of those big MSAs. Now, I know there's people that teach, hey, let's purchase, with a 50,000 metro, 50,000 population. Yeah, you could do that. We have just learned with our business model and what we like to do. We like to buy deals where we can double the value of the park relatively fast, at least within a 5-year period. It is easier for us to do that. It's easier for us to give those massive returns to our investors in a bigger market than it would be in a smaller market where I have to raise the rent $10 a year. Okay, it's just harder to do. All right. Also, like, some of this does matter, right? When you're looking to buy in these locations, because we have interest rates that are higher. Interest rates are coming down a little bit. Let's see what the 5-year is here. It is, it's going 3.421, baby. So there's been a shift here in the last month. I mean, the 3 deals that we closed last month, we were in at 8%. A deal we're closing in 2 weeks, we actually locked in at 7.19. So we went down almost a point. And why does this matter? Because this affects your ability to pay for deals. Like, you can't buy a 5 cap. It's kind of hard at higher interest rates. And I'm going to get into some of this on the outlook. I'm kind of skipping ahead here a little bit on the interest rates. But I still think that we have a big, tons of value, tons of investors that still want to get into this space. But as I was mentioning before, your interest rate, they are trending down. Okay, which is good for us, but we will see what the Fed does here coming up. Okay, so again, when we're talking about the location, before I get off track a little bit there, looking at those things, the population in the 2-bedroom apartment is so indicative of how strong the market is going to be, and really what you can get in lot rent, because the typical rule of thumb for that was like, hey, 50% of the 2-bedroom apartment is what your lot rent should be, and it's pretty close. It's pretty close. Maybe in some markets it can be a little bit higher, but it tends to work. One thing I'll tell you, when you're trying to figure out a location to buy in, nothing beats going there. Nothing beats going there. I can go to any location, and within 5 minutes of being there and driving around, I can tell you if it's somewhere I want to buy. I was visiting Myrtle Beach, South Carolina last year. We don't own anything in Myrtle Beach, in that area. I used to live there, actually. Partied a lot in college there. But the market was active Like there was a lot of stuff going on, like around the Grand Strand. If you know that area, like there's a lot of stuff going on there and you can just feel it. It's like it's an alive market. We also went and looked at a market. It was in Mobile, Alabama. Decent market if you look at the numbers, but if you go there, it's just like, it doesn't have that, it doesn't have that vibe. It doesn't have that vibrancy that I like when I'm purchasing a mobile home park. So a lot of this is feeling too. But you have to go drive the market to understand that. Okay. So when we're talking about these metrics, and we just talked about the location, like this is super important. Again, you got to figure out which locations you want to buy in. But now as we're coming into 2024, cap rates and interest rates, I got a little bit ahead of myself a second ago in talking about interest rates. But are cap rates compressing still, or are they going up? Well, it just depends. If you have the guy who has owned the park this is a perfect example of the deal we're buying right now in Orlando. This guy has to sell for one reason or another. He hadn't really disclosed it to me, but I think, there's some issues going on in his life or whatever, but he has to sell. So we're getting this deal at a great basis. He had to sell. The guy I talked to 2 days ago wants a 4 cap. He doesn't have to sell because if that guy that was asking for a 4 cap at his price, if he had to sell, you can almost freaking guarantee that he's going to come down on the price because no one's going to pay a 4 cap for this asset. And if he finds someone who would, please let me know because I'll crank off all of our stuff today at a 4 cap. Right. So I think it's not a matter of a general market thing. Cap rates are compressing or they're expanding. I think it just depends on the situation. I think it depends on the situation of the seller because the guy who does not have to sell, he's going to still say it's a fucking 4 cap, right? He's going to say, yeah, I'll sell. I'll sell. Sure. Pay me a 3.5 cap. Right. But the person who has to sell, that cap rate on what their financials look like will have to expand because otherwise the deal's not going to get done. Unless you're crazy and you just got a bunch of you're super liquid and you just got you got hot money. Right. But you still need to be prudent in what you're doing. So I don't think we can sit here and say that there's a consensus that cap rates are expanding or contracting. I think it's just a matter of what is the reasoning for selling. And you still have unreasonable people out there. I'm sure you've looked at deals on the websites. You've gotten emails from brokers on deals, and some of them are, probably not sellable. Maybe some of them are, right? So we'll see. We'll see what happens here. And we're talking about interest rates on this particular topic here too, like how this is sort of affecting your ability to finance deals. I'll give you a perfect example. So the deal that one of the Lakeland deals that we just closed, the owner's financials were terrible. Mom and pop, surprise, surprise. And we didn't know this until the end. We ended up getting only about 50% leverage on this deal. Of course, we didn't know this until the 11th hour, whether that's my fault or other people's fault, whatever. We still got the deal done. I had to come in and fund some extra there. But still, right, like in 2021, when we were looking at deals, the banks would consider like, hey, they would look at your pro forma and be like, okay, this is what you're going to do. And they would sort of take that into account to a degree. Now they're not. It's all based on historicals, in my experience. Maybe some people have experienced otherwise, but what we have seen dealing with lenders here, that they are looking based on historicals. They're just a bit more conservative than they were. We had deals, I still don't know how we got financed in 2021. They were just taking our track record and our ability to turn these deals around I was like, yeah, I trust that these guys are gonna do the right thing. I trust that they're gonna do the right thing. So it's definitely the interest rate environment definitely makes it a little bit difficult to get these deals financed right now, because you see the situation in Florida a lot of time. Like, if you know the market, you know that a specific price per pad is a good buy in that market. This Lakeland deal that we had, it was about 40, I think 46 a pad. That's a great deal in that market. Like, I'd buy anything at 46 a pad in Lakeland right now. But the rents were still not really supporting that. So the going in cap rate was lower. Therefore, the bank was not going to give us as much leverage. Now, there's an earnout structure on this deal. So once we obviously clean up the owner's disastrous expenses and his frivolous spending on things, and obviously do rent increases and fill up some of the vacant park-owned homes, our NOI is going to go up, our debt coverage is going to go up, and then they'll release sort of the rest of the funds. I think we'll probably end up getting to like 65% leverage on that deal. But in 2021, if that rate was 4.5%, we wouldn't have had to. I think we probably would have gotten full. The bank probably would have released the full amount of the funds at closing, right? So yes, interest rates are impacting your ability to do that. I still see people looking at deals and like, yeah, I'm gonna have to put 25% down or 30% down. Dude, I wouldn't count on that right now. I wouldn't count on that unless you got a smoking deal. You know, the deal we're closing in 2 weeks, we actually are getting 70% LTV on this deal, because the deal underwrites really well, because we have other parks in the area and we have high lot rents in those markets. So the comps are there. But I would just be careful when you're looking at deals, because you may have this happen to you like it happened to us. We had to bring an extra, I think, 150 grand to closing after we'd already raised all the money, and I had to step in and handle it. It was a blind side, and it sucks, but it is what it is. It is what it is. And then in this deal that we're about to close, me being super conservative after that happening, of course, we raised more money than we've needed on this deal. So, again, just be cautious. Just be cautious when you're going in those deals and trying to figure out, hey, this is the amount of money that we need to bring to close this bad boy. Okay. Now, rent growth. Rent growth. Is there rent growth happening right now in mobile home parks? And I'll get into why I'm talking about this right now. Yes, there is. Maybe not 2020 or 2021 rent growth, because we've actually seen in some of our markets, Orlando and Tampa, that multifamily rents have actually started to level out and or come down slightly. Now, does that mean mobile home park rates are going to go down? I don't think so. I don't think so at all. Now, you may have to do more modest. You may have to keep 3 to 5% increases every year. You probably wouldn't be able to go over that. Maybe less. Maybe you don't. Right? Maybe less. But because we're affordable housing, because it's scarce, because they're difficult to build, why all of us that tune in here, why all the people that I talk to love mobile home parks, is because of these underlying factors, right? We've got the high demand and low supply aspect of the asset class is massive. So I still think we will see steady rent growth. And I still think that we're seeing that. Operators I've talked to are still doing rent increases every year. And look, let's just get the cow out of the bag. People talk about, oh my gosh, the rent increases in mobile home parks. God, you're just such an evil person. That's freaking bullshit, dude. Like, most of these parks, dude, one of the parks that we just bought in Lakeland, a different one than we just bought. If this park if we had not purchased this park, I freaking guaranteed you the county would have shut this freaking place down. I guarantee you, like, it's a disaster. It's a disaster. So we're going to come in and spend $75,000 on the roads. We're going to paint and skirt the houses. You know, it's like $200,000 of CapEx into the property. And yes, rents will have to be increased to do that. Right? But otherwise, this park would be gone. And there's 30 units in this small park, and these families would not have a place to go. So, back to rent increases. I could just go about that all day, but you know, I still think that it shows in our direction where the rent increases maybe modest, just fine, and but it's still going to go and drive the value of this. Also, when I've been, you know, looking at investors now coming in to buying and getting people to invest in deals now, there is increasing interest, if not, there's definitely increasing interest in people investing in this. And the people that don't, I just don't think they understand the asset class, because that underlying supply and demand factor, couple that with you buying in a strong market, is massive. So in this part, when I talked about, you know, interest rates and cap rates, so you do have to take this into consideration when you're looking at a park, what the in-place cap rate is, but you also have to put some future into it. Nowadays, because prices tend to be higher, I haven't seen, look, there's deals that pencil with the in-place, right? But it's not as appealing if you don't factor in, like, okay, we're going to be able to take rents here. We're going to be able to fill these park and homes here. We're going to build back for utilities here. So we need to look at it from that perspective, because if we just looked at the deals based on the in place, what the numbers are doing based on what the seller's doing, like, I don't think you'd ever buy anything right now. I just don't think you would. I mean, the last 3 deals that we've closed on the owner's numbers, I just think now you have to take into account what you're going to do in the first year to get a good idea of, hey, can we buy this or not? Because if you just look at what's going on in place, like, you're not going to be able to, like, there's not going to be many things that pencil that well. Okay. Now, getting into operations. When you're looking at deals, some of these metrics you need to consider on operations, and what we have seen now is obviously inflation. Inflation's happening, folks. Now, the media can lie about the numbers and, you know, lie about the jobs numbers, as they do, right? And if you think they don't, okay, I don't know what to tell you. But the cost of shit is going up. I mean, there's no question about it. And so you have to take this into consideration with your utility costs and your repair costs, because even, you know, some of the stuff that we would, you know, factor in for CapEx in 2021 and 2022, you know, I think we paved Sunshine for like 40 grand. Okay. We got a quote on a park. I guarantee you it's probably the same size, if not a little smaller, for 75 grand. Okay. For asphalt. And if you hadn't sort of looked at these things or called and gotten quotes on these things, they can screw up your calculations, right? So you have to factor in inflation, because if you're going by some data that you're like, okay, I think I can pave the roads for 40 grand. Nowadays, you better call and get a quote on that, because you could get screwed easily thinking that that's what it's going to be. But I don't know. You know, with these contractors and stuff days, like, I just don't know what I'm going to get back. And it's harder for me to be confident. So that's why I call and get quotes, right? And when you're doing this in your underwriting, you also need to factor in the yearly increases of this stuff. We used to do 3%. I actually changed my underwriting to 5%. Okay, because on a pro forma, I would have the cost of each line item, utilities, R&M, G&A going up 3% per year. But now I don't. I have 5% per year in there now. And look, if prices don't go up that much, then I'm being more conservative. All right? I'm being more conservative on that. So you just have to think about this, right? Your expenses nowadays are not generally going to stay the same every year. They will to a degree, but they're going to increase, right? And our hopes is that obviously rents will outpace inflation, which they still will, as we just talked about. Okay. Well, the next thing here, this is one of the biggest things when we're talking about this, talking about the future of mobile home parks, regulatory changes. This is definitely one of the things that scares me the most about this asset class, because the crazies in Washington, D.C., who knows what they could pass? They could pass some national rent control. They could pass some other crazy thing, which they've already done in places, that could severely impact the value of this asset class. I don't know if they'll do that. Maybe they will, maybe they won't. In Florida, in Chapter 723, there's actually a clause in there that specifically states that if a municipality or something actually does implement a rent control, that it's not allowed, right? So there is some protection there in some states, but it's definitely a worry for me going forward. Not that big of a worry, but it is something that we could think about. I mean, shit, they're talking about capital or taxing unrealized capital gains. So look, there's no limit to how crazy this shit can get. So, you know, I would just keep an eye out on that when we're looking at stuff. Okay. So now I want to get into talking a little bit about you know, just how these market conditions have affected our ability to buy deals from an acquisitions perspective. You know, we talked a little bit about this before, how it has made financing a little bit trickier, because you really don't know what the bank's going to come to the table with until the 11th hour, until you go to committee, which sucks, right? Which sucks, but you know, it's just something that you have to navigate here. You got to navigate that through this market, because I'm telling you now, you know, now is a great time to buy. Despite of what people tell you or what they don't tell you, like, now is a great time to buy. Why do I think that? Well, because I think the higher interest rates gives us a, you know, more of a margin of safety to where we can actually, hey, I am of the belief that interest rates are definitely going to go down. And if they don't, we're penciling stuff at 7 and 8%. If it pencils now and the deal's good now, it's definitely going to be good if rates go down. But if rates go up, you're still going to be okay, because you're going to have increased NOI. You may not have as big a pop on the end. Your equity multiples and your IRRs may not be as big, but it's still going to be a good deal. You know, I still think we can outpace the market, and we can still deliver above average returns to our investors, even if the market just stays flat, or even if rates go up a little bit. God forbid. Right? So, you know, I'll tell you what some lessons that we learned from these recent acquisitions that we've had is just, you know, you need to be more conservative in your numbers. You need to be more conservative when you are underwriting in your pro formas and what you show investors on, you know, what your leverage is going to be, what you think it's going to be, because the bank will give you a they're going to give you a term sheet that'll say up to 70% or something, but you don't know exactly until they get in and underwrite the damn thing what it's going to be able to support. You can get an idea of where you're going to be, but you need to always err on the side of caution, right? I'm a very positive guy. I always think of the best things that can happen, but when I'm underwriting real estate, I'm freaking negative. I'm super conservative. I'm very conservative. I want the deal to be good if shit hits the fan. And we learned that the hard way in this deal. In this deal, because the bank, we needed an extra 150 grand to close, right? Not a lot of money, but it still was like, okay, I got to come in and fund this. It can still make for an interesting close. An interesting close, because it's just a barrier that you have to get over, and you're gonna have to deal with if it comes up. And now I would say more like, this is super important, negotiating deals. I negotiate every deal. Okay. And I don't do it just to do it, to be an asshole. I negotiate, after due diligence, after I do all my inspections, and I get quotes on everything. If the septic's jacked up, I get quotes on what it is to replace it the right way, not a Saturday septic guy. I get quotes on how to do it the right way, and then I'm going to go back to the seller and be like, look, you see the septic's going to cost us 25 grand. You see we got to find a bunch of titles. It's 25 grand. We got to find this. We got to find that. It equals $84,000, right? And I always throw a little pain and suffering in there, depending on what it is, right? And so then I go back and ask for a reasonable discount. I'm just not doing it for shits and giggles. I'm doing it, respective. Like, I'm not just doing it. I think there's people out there that just retrade to retrade. I'm retrading based on facts. I'm retrading based on hard numbers and analysis that are justified. I've never been one to just go put someone under contract in hopes that they'll retrade at the end. I don't roll that way. Typically, when I get something under contract, I'm going to buy it unless there's something that sort of comes up that we don't like, or if could be a timing issue, which you actually had that on the deal a month ago. And so, look, negotiating is important, especially in this market, because even those little negotiations in purchase price can increase returns for your investors. They're going to, just make the deal better overall. And they're going to make you feel better about the deal too. Because I don't think if you have a $50,000 septic issue that you find in due diligence that you should have to pay for that. You should not have to pay for that. That is not your deferred maintenance. Now, sometimes the seller will be like, yeah, fuck off. I'm not giving you a discount. I haven't had that happen when you use this strategy. I've never had that happen when you use this strategy. I'm using hard numbers, and I'm using the cold, hard facts to say, hey, this is the discount we need because of this. Like, we didn't know about this. We didn't know we were going to have to pay 50 grand for septic. We didn't know we were going to have to pay 25 grand to find the titles. We didn't know we were going to have to pay 30 grand to fix the well or to redo the sewer lines here or blah, 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 blah. So negotiation is important. Negotiation is important at the end, and you have to do it the right way. All right, so as we're rounding up here to the end of the show, look, I think that the main thing, as we go through here and look at these things that you need to consider when you're looking at a deal nowadays in 2024. Obviously, the market is super important. Even in 2021, 2022, whatever year it is, the market was important. So the location matters. And in fact, you should probably find the location that you want to buy in before you even, start, right? That should be one of the first things that you do. And I don't know if I mentioned this before. I'll just give you a little tip here. Like, if you really want to figure out if the locations are good, put a test ad up on Facebook Marketplace. The perfect example of this was that when we were buying those parks in Lakeland, I put a test ad up. I got I think like 200 responses within 3 or 4 days. We were looking at another deal months, probably the beginning of this year. Guy on our team put an ad up. It's like, oh, we got 7 responses. How many days? 5 days. Oh, that sucks, right? It sucks. Or we got 10 in a week. Like, that's not good. That's not good. Where do you think you're going to be able to sell homes faster? Where do you think you're going to be able to fill up vacancies faster? Obviously, in those markets. So look, again, the location factor is key. Looking at cap rates and interest rates now is going to be a big factor. Okay, you're going to need to look at you're going to need to know kind of what the market rent is, like what you can get in rent there. You need to know that. All right, and you just have to be a bit more conservative now on the stuff with the bank, as I talked about, and on your operations pro forma, and what your expenses are going to be, and what that is moving forward, because you never know. And look, when you're underwriting, and I know, like, me being an optimist, it's so hard, and I still fall into it sometimes, where I'm like, okay, I'm going to look at the optimal part of this. I'm going to be very positive about this. Oh yeah, I can put, we're only going to have to bring 25% of the purchase price to the deal. We're going to be able to do this. We're going to be able to do that. Like, oh yeah, and it's going to cash flow 20% in the first year. It's great. You should definitely look at a best case scenario. But I like so I'll look at a best case scenario, like a knock it out of the park scenario. For one, I'll look at a scenario that I know that can happen because we've either got stuff in that market that's performing that way, or I know the market, whatever it is, right? But then I'll actually pull back that projection. So, for example, in this one of the deal that was a disaster that we purchased, the heavy turnaround deal, I was projecting, I think it was probably 65 or 70% of what I knew we could get the NOI to in the first year, because there was park-owned homes to convert. There's some vacancies to fill up there. And the deal was really good at that point, right? But I didn't project to investors and on my pro formas that I was going to get there. I did 60 to 70%. I have to look at the numbers, just in case something happens. Because if you've bought parks before, shit happens. And so now I have the confidence to go in and say, hey, this is a great deal, because this is how we're being conservative on the deal. I love to talk about that to investors, how I'm being conservative on the deal. Hey, we've projected a 5% increase in our expenses every year. We've projected a much lower NOI in the first year than what we can get, and on and on and on and on and on. Right, so there's a margin of safety there. There's room for error. There's room for mess ups and screw ups and things that are inevitably going to happen. Okay, and you'll have a successful deal. You will have a successful deal. If you want to learn more about this stuff, we can put up the link here. I thought we were going to be able to do that while we were going through the show. But we'll have this in the show notes for sure. And it's multiple mini courses that will teach you about how to buy a mobile home park and all the basics that you need to know. So we'll put that link in the show notes here. And also, look, if you're looking for, I've got 3 people in my mentorship program right now. And if you're looking for the hand holding that you need, if you're looking for the no bullshit, like I literally take all the bullshit data, pull it out, and say, hey, these are the things that we need to know to get you a deal under contract. Like that specific, the mentorship program is specific to like, we will find a deal in this time frame. Now, if you don't do anything, we won't find a deal. But hey, these are the things you need to do. We don't need to worry about what our process is for, pumping septics when a septic's overflowing. We don't need to know about that shit right now. We need to get a deal. We need to get you a pipeline of deals and start putting out offers on these things. And so I'm there with you every step of the way to talk about deals. I'm your freaking, you can call you, like people in this program call me like anytime. Hey, is this deal good? We're going to underwrite deals together. We're going to make sure you're confident and you're making the right decisions. And so it's great. It's a no BS, like, hey, these are the things that we need to do to get a deal. So if you really want to get a deal, you can reach out to me because we have a spot opening up in that here within the next few weeks. I can only do a few of those at a time. So be happy to talk to you about it. Would love to set up a call. You can shoot me a message on social media. And also, if you are if you're a passive investor and you'd like to talk about potentially getting on our investor list at Victory Capital, you can send me a message at I'm Derek Vickers 885 on all the social media platforms, or you can email me at derek@victorycapital.com. Would love to chat about your investment goals and see if our deals fit your criteria. We've got a lot of deals in the pipeline, and it's going to be, I think, a big close here to 2024. So if you reach out to me at derek@victorycapital.com. And look, if you like the show, I know I go all over the place sometimes. I get it. But I've gotten good feedback from people. They love the show and they love what we talk about. And I try to be as real as possible. I don't have this social media veneer on where I'm like, I'm just me. So if you want to be a part of that, please let me know. You can email me at derek@victorycapital.com. We'll have some links in there. And, if you didn't catch this now on the live, we'll be on Monday. It's a crazy world out there, folks. It's a crazy freaking world out there. Don't get stuck in the politics. Okay. This is the reality of the situation. Sometimes I do. I get a little like, oh yeah, political. This is reality. You need to get as wealthy as possible. You need to get out there and build your wealth. And mobile home parks is a way to do that. You need to build your wealth because once you get wealthy enough, the rules don't apply to you. Let's just be real. The rules don't apply to you. So look, that's what I want to help you do. I want to help you create financial security for you and your family. I want you to create generational wealth. You can do that in mobile home parks. I'd love to help you. I'd love to show you the way and show you exactly how I build up a sizable portfolio in a short period of time. You can email me at derek@victorycapital.com. And we will see you all next week on the MHP Show. Peace out.